Hello, everybody, and welcome to my solution walkthrough for exercise 5-6. This is from the Intermediate Accounting 17th edition, the Intermediate Accounting textbook by Kiso, Weingart, and Warfield. This is a textbook that I used when I was learning accounting. I was on the 6th edition. However, this is something that I really consider to be the gold standard. I have been using the 16th and 17th edition now for the 5 years that I've been teaching the first semester of intermediate accounting. And again, I really want to thank Wiley for allowing me to use their questions. So the questions used in this presentation are copyright 2019 by John Wiley and Sons. All rights are reserved for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. And this solution presentation is copyright 2019 to 2021 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of mine or Bennett Tchaikovsky and not the authors of the textbook or Wiley. Okay, so let's go ahead and take a look at exercise 5-6. And this came from one of my students who actually, she was absolutely right. I did need to make videos for these. And so that's what we're doing. Well, let's take a look over here. So we've got exercise 5-6, corrections of a balance sheet. The bookkeeper for Geronimo has prepared the following balance sheet as of July 31st. So the following additional information is provided. Cash includes $1,200 in a petty cash fund and $15,000 in a bond sinking fund. The net accounts receivable balance is comprised of two items, the AR and then the allowance for doubtful accounts of $3,500. And it gives us some additional information here. And what we're required to do is to provide a corrected classified balance sheet as of July 31st from the available information. So I'm not going to spend a lot of time talking about the classified balance sheet. If you look at my solution for this, I spent a lot of time talking about and showing you different examples of different publicly traded companies. And I'll put the link to this at the bottom of the video. But over here for this particular question, let's just kind of get to it. So we have Geronimo Company, balance sheet as of 7/31/2020. When I'm doing a classified balance sheet, right, what I'm going to be doing over here is I'm going to have assets, and I'm going to separate these into two different categories: current assets, and then I'm going to have non-current assets. And this is going to give me my total assets. I'm then going to have liabilities. I'm going to have current liabilities. These are not electrified, bad humor. These are rather liabilities that are due within 1 year. I'm going to have non-current liabilities. Total liabilities. And I'm going to have owner's equity. Total owner's equity. And then my last part here is going to be my total liabilities plus owner's equity. That is how a classified balance sheet is structured. We're separating our current versus our non-current assets. Again, check out I have a much longer discussion about this in exercise 5, my solution exercise 5-5. Okay, so we've got cash right here. Cash is going to be current. Now, but it tells me that $1,200 in a petty cash includes $1,200 in a petty cash fund and $15,000 in a bond sinking fund. Okay, now the petty cash sitting in there is fine. The $15,000 and a bond sinking fund is not. Okay. When I see the term, what is a bond sinking fund? Oh, sinking fund. Basically, what they will do, a sinking fund contains money set aside or saved to pay off a debt of a bond. A company that issues debt will need to pay that debt off in the future, and the sinking fund helps to soften the hardship, right? So what this is going to be is a sinking fund is it is cash, but we're going to list this here as a non-current asset. Why are we using it as a non-current asset? It's because we're using it ultimately, it's being set aside to satisfy that obligation. So my bond sinking fund is going to be 15,000. Okay, so my cash is going to be 69,000 minus 15,000 from the bond sinking fund. I am reclassifying this amount out of cash into a non-current asset. Right over here, my total cash balance, if I add up the two balances, it's still going to total 69,000. Right, but I'm separating this because this 15,000 is basically being earmarked by management or by our board of directors to basically be over here as a non-current asset. Okay, so the net accounts receivable is comprised of two items: accounts receivable and the allowance for doubtful accounts. So when I go over here to accounts receivable less the allowance for doubtful accounts is going to give me accounts receivable net. So my accounts receivable gross is 44,000 minus my allowance for doubtful accounts, which is going to be 3,500, is going to give me accounts receivable net of 40,500. So that's where that number is coming from. And let's just make this a little bit bigger. There we go. Okay. So that's letter B. Okay. So letter C, here we go. Here's some fun. Inventory costing 5,300 was shipped out on consignment on July 31st. The ending inventory balance does not include the consigned goods. Receivables in the amount of 5,300 were recognized on the consigned goods. What does consigned goods mean? Well, if we look up okay, consignment is an arrangement which pools are left with a third party to sell. Basically, you receive a portion of the profits. And so basically, what are examples, right? So what happens here is that I haven't sold it. Rather, I'm giving it to somebody on consignment. So the problem here is that inventory costing was shipped out on consignment. The inventory balance does not include the consigned goods. That is incorrect. So this inventory needs to include the consigned goods. So if I look at this over here, right, just from, if I was doing this with T accounts, so right over here, I've got inventory. Okay, so right over here, my inventory of $60,000 does not include the consigned goods. It needs to include them. So what am I going to do? Well, I need to add them back, right? Because I still own that inventory. I should not have taken them off my books. When I'm consigning something, I will take it off once that agent or that third party has actually gone through and sold it. So my inventory is going to have a balance of 65,300. Okay. So again, my inventory, it's not 60,000. I've got to add this up, right? But over here, I recorded it as part of accounts receivable. So my accounts receivable gross was 44,000, right? So over here, receivables in the amount of 5,300 were recognized on these consigned goods. That $5,300 should not be in there. So what I'm going to need to go through and do is remove it. When I remove it from the accounts receivable, my ending balance here in AR is now going to be 38,700. So now what I have here, So this, my pre-balance here was 44,000, right? From coming over here from number 2. And I've got to remove it because I should not have recorded a receivable as a result of shipping out those goods. So right over here, 35,700 minus my ADA, it's going to give me 35,200. Okay. So equipment had a cost of 112,000 and accumulated depreciation of 28. So when I look at that part here, right? So equipment always going to be a non-current asset. So here we have equipment less accumulated depreciation on the equipment is going to give me equipment net. My equipment net balance is 84,000. Where did this come from? Had accumulated depreciation of 28, equipment of 112,000. Again, I want to encourage you to watch the video that I just made on exercise 5-5, where I will show you different examples of different publicly traded companies and how they go through and they show this. So you're going to see that there's kind of a variety of different ways to go through and to do it. Okay. All right. So let's kind of take a look at where we are right now. So we've got them patents. So my patents were 21,000. And so let's go up here though first. So my total current assets right now through the number 4 are going to be 54,000 plus 35,2 plus 65. Okay. Over here, basically, we've got for my total non-current assets, so my total non-current assets are going to be my bond sinking fund, equipment net, and patents are of 120,000. So my total assets tentatively are going to be right over here at 274,500. Okay. So let's go ahead and just take a look at liabilities real quick. So we've got over here current liabilities, right? So I've got notes and accounts payable totaling 44,000. Okay. So my total current liabilities as of right now are going to be 44,000. For non-current liabilities, I've got long-term liabilities. My long-term liabilities up here are 75,000. So my total non-current liabilities up here are going to be 75. And my total liabilities as of right now are going to be my current plus my non-current. Okay. So I did this intentionally because I want to look at number 5 last. Okay, so let's go ahead and take a look at this. So income taxes payable. 6,000 were accrued on July 31st. However, Geronimo had set up a cash fund to meet this obligation. Okay. So what they did is they basically said, okay, if I'm looking at this over here, and you'll see a lot of times that I go through and I use T accounts. Why do I use T accounts? Assets are equal to my liabilities plus my owner's equity. And then I've got debit, credit. Why do I do it? Assets typically have debit balances. They're increased with debits and they are decreased with credits. Liabilities and equity accounts are typically have credit balances. They're increased with credits. They're decreased with debits. You'll see this on my earlier videos. So over here, and then where do we not want to end up on the room is ER, expenses, and revenues. So my expenses are typically going to be recorded with debits. My credits will be typically recorded with, my revenues will typically be recorded with credits. So when I look at the wording of number 5, it says that income taxes payable of 6,000 were accrued of 6,000. And we had set up a cash fund to meet the obligation, right? But what they did is they said, we're just going to offset these guys right over here. And we're just going to go ahead and get rid of this. We're offsetting them. So over here, we get a balance of 0. Can we go through and offset this? Absolutely not, right? We can't just go through and arbitrarily offset these items. So what I'm going to end up doing right, is basically I'm going to reverse the curse, or basically do this. I'm going to increase my cash balance by 6 grand. So up here, instead of being 54,000, right, I'm going to add in another 6 grand, right? So if we're looking at this, 69,000 original balance minus the 15,000 bond sinking fund plus the $6,000 for the offset reverse offset income taxes. Okay, so my cash balance is now going to be 60,000. My total current assets are now 160,500. My total assets are now 280,500. Over here, right, for my current liabilities, I'm going to basically now have income taxes payable. My income taxes payable are going to be $6,000. So my total current liabilities are now going to be my notes and accounts payable plus the $6,000 right over here for the income taxes payable. So my total current liabilities are going to be 50,000. My non-current liabilities are going to be the 75 right up here. And so now I get to my last part. Okay, so this is the last piece of additional information. So for my owner's equity, and again, you probably wouldn't see it like this. My owner's equity is just listed as 155.5. Right, and why wouldn't you see it like this? Because typically what you would do is you would be showing it as, you know, common stock par, additional paid in capital, retained earnings, and the like. Okay, so my total liabilities and owner's equity is going to be 125 plus 155.5 or 280. And this magically equals our balance right up here. So this basically we are good to go, and we've gone through and done this problem. So the thing that kind of messed me up in terms of going through and when I was originally doing the problem was this part right over here, because basically, you know, they did some kind of an offsetting entry, which you can't do. But again, that's how they're going through and showing this. So this is your solution for this particular question. Okay. And I want to take this time to basically, if you think I'm crazy for doing this, I apologize, because like, look, I was asking Wiley and the other publishers for years to be able to use their questions, and they finally allowed it. And I think it's because I show them that everything's pretty much on Chegg, and that a lot of students appreciate videos where I absolutely make these videos way too long and everything else. So I want to thank Wiley for their allowing me to use their questions from the 17th edition. Don't forget to like and subscribe. If you have other questions that are in this textbook that you would like to see, please go ahead and ask me in the comments. Have a great rest of your day, and I look forward to seeing you on the next video. Have a great one.